Hey traders, welcome to Charts and Coffee. Got everybody in the house here. All right, welcome. Good to see you all. We are dealing with the aftermath of the PPI. So let's jump on over to the economic calendar here for a moment. There's a handful of economic calendars that are out there that are very good. Forex Factory is probably the easiest to use because it's very easy. It's very straightforward to identify the red hot zones, as I like to call them, where the impact based on volatility, based on macroeconomic importance is pretty easy to see. They're red, right? So you can see there, core PPI, core retail sales. And if you notice, I haven't even refreshed this page because the actual number is way secondary to simply the reaction. The reaction will tell us everything we need to know. The reaction in the broader averages, the reaction in the euro bonds, you could look at gold, and of course the reaction in the target rate probabilities. That's always the question. Are they shifting? And don't worry about March and May, because those are very much firmly in the hold camp. We're not going to see rate cuts. Very unlikely to see rate cuts in May. Forget March, right? That's in 6 days. The Federal Reserve is not going to change course that quickly. Even if they had a reason to cut sooner, they wouldn't, because it would send shockwaves of panic through the markets, because they'd wonder, oh my gosh, if they're sort of surprise rate cutting, what's really happening? And there'll be panic. There's so much psychology that goes on in terms of what the Fed says and does and the timing. So May really would be the first time we think about it. It's not even close to being discounted. Remember, what's probabilistic is different than what's possible. What's possible is a 10.2% expectation of a cut. What's probable is the nearly 90% chance of the hold. So that brings us to the June 12 meeting. And the June 12 meeting sits pretty firmly in the high 50s. We've been as high as the low 60s, I think 62 and change. But this is still pretty unchanged. There's nothing about it that suggests a far lower probability of a rate cut. But this hold column sitting at about 35, 30 to 35, it's still prominent enough to make that not the probability, but the second most likely possibility, right? So that's where we sit. And that's how you measure what happens. If you take a look at these hot zones when they come out, say, well, what does it really mean? Where it lands, the importance of this data is, what does it mean to the Federal Reserve? The Federal Reserve is the macro, right? The Federal Reserve is the macroeconomic importance, period. Everything else is just data that leads to them making decisions and their messaging, and are making decisions about their decisions, right? So that's the way the game is played, and that's where we sit here this morning. Let's go take a look at what is going on in the broader averages. Probably the most obvious thing to note, although the bell won't ring for another 26 minutes, is that we are sitting above the previous session close, which was sitting at 52.37 3/4. So I'm just going to update that manually, just like that. And that is my PSC. That's the previous session close. That is the line in the sand. And being above that would be putting price action today in the bullish hemisphere. So I will, for as long as we remain above that level, be bullish. By the way, I'm bullish anyways, right? There has been nothing. There has been nothing in the last handful of weeks even that would suggest that any of the weakness is anything more than a dip on the daily. Now, what we do day to day as traders, right? That's going to be something we can determine at the bell. That's going to be something we can determine. I think it was at 18.3. Oop, what did I just do? I just sent it out down into the, there we go. So all I need to do is just move this line, boom, right about there. Okay. So as long as we're above that previous session close, as a day trader, I'll be bullish, right? Whatever happened yesterday. Now let's separate how we can day trade better to be bulls or bears any given day. It's not necessarily what happened yesterday. It's where we sit in relation to what happened yesterday, right? So if I'm sitting above the previous session close, a lot easier to be bullish. If I'm sitting below the previous session close for that day, maybe just the morning, or for as long as we remain below that cash close, I can be bearish, right? So that's really going to be not what happened yesterday, but where do we sit in relation to what happened yesterday? Exactly. James, spoiler, Raghee is bullish. And by the way, can we just accept that that has been the path to profitability, right? By no means am I saying, hey, just get long and you'll win. No, trading is a little bit more complicated than that. However, if you're looking for high probability setups that are going to follow through, the only direction to be trading in 2024 is to the upside. I don't just say that, I show that, right? Every single day in the Sector Secrets Mastery and the days that I'm in the Simpler Central room, we have continued this entire book of mine from the very first trading day of January to where we sit now. I don't believe there's a single, I'm trying to think of all the trades we've done since the beginning of January. I don't think there's a single put that I've bought, right? Dips happen. Exactly. Dips happen. And when they do, in an uptrend, we want to continue to buy. So I'm not talking about what I think and what I feel. I'm not trying to pick a top. I'm not here to analyze the market, really. I'm here to tell you what I'm seeing so we can get to work, right? There's a big difference, big difference. The folks on television, like weathermen, right, get to talk about whatever they want. I was watching a really interesting interview with someone who is to be very respected because he is the GOAT of trading, and that's Stan Druckenmiller. Stan Druckenmiller is an interesting and clearly genius trader. What's interesting about him, and this is where you have to be very cautious about any opinion. What's the saying? Strong opinions loosely held. Stan Druckenmiller is the epitome of that. That guy can be on a 2-hour podcast, webinar, video, and just lay out the most convincing scenario for why he is expecting the world to end. And he's done that. 48 hours later, he'll be net long. That's not to say he's being deceptive. He's not. I really do believe at that moment in time, based on the data, he says, gosh, it's time to be bearish. But he will change his mind, right? So be careful when you're listening to folks, including me. Make sure you know, Rog, what time frame are you looking at? And that will map to the time horizon. So if I'm a bear today, that's a 5-minute time frame. That's looking at a 200 propulsion, a 5-minute time frame. That's looking at the fact that price is below the previous session close. And that is a 2-day trade, right? When we're thinking day trading, think today. But my longer term opinion is going to be held in a 1 hour. That might be the next 2 days, 1 to 3 days, right? If I'm pulling up a daily, this is going to be days to weeks, right? In terms of my expectation for follow through. So remember, the time frame we look at is very, very important in terms of that time horizon and follow through. And a lot of times, any confusion or disagreement or whatever about what the markets are going to do, as if any of us really know, right? But as far as analysis goes, all of that disagreement or sometimes confusion comes down to time frame, time horizon. So at any given time, if you're asking, Rog, what's your time frame, time horizon? Ask me. I'm happy to tell you, right? So that is it. All right. So let's see. First question. Cash Insomnia asks, barring all the crash mentality. Oh gosh. By the way, can we just call that clickbait? Because that's all that it is. Is there any merit to a decrease in valuations following an inversion? Okay, Cash Insomnia, thank you for the question. Inversion, anyone who's talking about yield inversion, I'm going to leave it at this, doesn't have a clue. I'm not saying you don't. You're hearing other people talk incessantly about it. It has been wrong. We've been inverting and not, we've been doing this for about 2 or 3 years. Where's the crash? So no, just no. And by the way, again, if anyone wants to start talking about yield curve inversion, it is 2 things. It's 2 words. Clickbait. Is clickbait 1 word or 2 words? That's what it is. It's clickbait. That's it, right? Because that's just, hey, you know what that is? By the way, why is that clickbait? That's clickbait because while the markets are going higher, the easiest thing to do to get somebody's attention is A, scare them, right? A, scare them, and B, say, I see something you don't. By the way, gang, I don't do that. The markets are going up and anyone should have the feeling of, no duh, Raghee. That's it. That's it. Stay calm and buy the dip. That belongs on a t-shirt, Pierre. I love it. I love it. All right, moving on. Let's see what we have here. Can I provide some thoughts on PAHC? All right. I don't even know what that is. Animal Health Fibro Animal Health Corp. I'll tell you this. I'm happy to break it down. Is it? I don't know if it's a hard J or a soft J. Jovian Blue or Jovian Blue. Sorry if I mispronounced your name. I'm a Raghee. I can totally understand. It's an uptrend-ish. It's sub $20. So here's what I'll say about anything under 20 bucks. Pull it up on TradingView. Take a look at the volume. Anything under 20 bucks is purely a volume game. It's a volume game. So definitely keep an eye on volume, really even more so, frankly, than price. Because under 20 bucks, price is not driving psychology. It's very much volume. So keep an eye on that. All right. Let's see. Next up was, let's see, 2022. 2022 was bearish. I can't even remember 2022 anymore. Yeah, let's just bring up a few years, shall we? Sure. So if I take a look at, this is 2023, and there is, so I push to, there you go. There's 2022. Yeah, you have to be able to go, but absolutely. Absolutely. You have to be able to go look at the structure of the market. Now, by the way, how easy is structure? Most of my candles in 2022, this is PACH. Let's do this in S&P. That would be far more helpful, wouldn't it? There we go. So most of my candles in 2022, this is this segment right here, we're below the 200, right? So good point. One of the easiest ways to understand where the sentiment is on a daily time frame, heck, even a weekly, is to look at where price action is in relation to the 200 propulsion, which is a combination of a moving average cross, an exponential moving average 8 and an exponential moving average 200. We're looking at the cross. So yeah, if we're spending most of the time below, but it's really interesting, Mocha Frop. 2022 was probably the biggest year for me to build my longer term portfolio. So coming back to time horizons and talking about something we do in the Sector Secrets Mastery, I probably had more entries on my longer term portfolio in August to October of 2022 than, outside from 2019 and 2020. That was probably my biggest, most recent time to add positions to my longer term portfolio. So yes, good point. Absolutely. Every year is something different. So what are those cues, whether it's the color of the candles on my chart, whether it's where we are in relation to the 200, what are those cues to let us know? Absolutely. Absolutely. All right. Next up, Anthony asks, was the Fed pause a bullish signal, or are we trading bullish in anticipation of the pivot? It's, well, there's a third thing, Anthony. Was the expectation of the Fed pause bullish? Yes. Is the pause bullish when we were hiking, of course? And are we continuing? So it's kind of all of that plus the anticipation of the pause being bullish. Yes. So all of that is true. Correct. You got it. Hard J. Okay. Thank you. Thank you. Yeah. So all of those are bullish. The anticipation of the pause is bullish to equities. The pause itself is bullish, and the anticipation, getting ready for the pivot, also bullish. You got it. So let's go take a look at a few places that aren't quite convinced of the Federal Reserve's decision and timing, and that is bonds. Bonds have found their way above the 200. It will be key that they remain above 119 on the long bond futures contract. And I would prefer to be long bonds than short, because again, anticipating lower rates, I certainly don't want to be expecting higher yields, right? Now, remember, yields and the direction of the bond contract, ZB futures or TLT ETF, those are inverse to the yields. So when yields are going down, as we anticipate they will, those symbols, ZB and TLT, go up. And so the bond market is not quite convinced, right, that the Federal Reserve's timing is necessarily right. They might be taking too long. However, take a look at how, and this kind of goes back to, Anthony, your question. This is that run up in just accepting that the Fed is going to cut rates. Bond yields can't stay down, or should say bonds can't stay down, yields can't stay up when the pivot is around the corner. So you can see the biggest adjustment to the reality of rate cuts coming was from mid-October to about early December. And then now we're levitating. Now we're just hanging in there because bonds know, as we all do as well, that the certainty around which meeting the rate cuts will commence, and then also how many rate cuts will we get this year. It's still looking like 3 to 4 quarter point cuts. We don't know when, and we don't know how many. So bond yields don't have a huge reason to continue to decrease. Therefore, bonds don't have any reason in price to increase, but there's no reason to sell off either. So they're just levitating. See how they rallied up, and now they're just moving sideways. They're sort of levitating. Another place that's not quite convinced is the U.S. dollar, and the U.S. dollar is best viewed through the lens of the euro. And the reason I say that is because the U.S. dollar is never just the U.S. dollar; it's the U.S. dollar basket. And it's primarily what is the dollar doing versus the euro, the pound, and the yen. And there are some other currencies kind of fairy dusted in there, 3 other currencies that have very low weighting in the basket. This is a high concentration weighted dollar index, much like the S&P index or the Dow index or the NASDAQ index. And so if 58% of dollar index is this thing, this is the easiest and clear inverse correlation. So if euro's heading higher, dollar's heading lower. It's really that's straightforward. In fact, the correlation, the negative or inverse correlation between the euro and the US dollar is consistently in the mid to high 90s. So, I mean, this is a very tight correlation. Again, negative. One zigs, the other zags. That said, euro's above the 200. It's in the bullish hemisphere, which puts the dollar in the bearish hemisphere. All right. So that we don't really have, this looks a lot like bonds, right? Where they're not quite convinced that the dollar is going to weaken. By the way, why would the dollar weaken? Anytime a country starts to cut rates, the stock of a country, which we can consider the currency, starts to weaken. However, because other central banks are thinking about cutting rates as well, like the European Central Bank, they're a little further down that eventual cutting cycle. The euro is going to be moderately stronger than the dollar. But once the European Central Bank starts cutting, then this becomes a lot more fuzzy because now you've got 2 dovish central banks, you've got 2 currencies, and then it just becomes a race to see who's weaker. And who's weaker will be based on how many cuts that central bank is willing to do and how rapidly they're willing to do it. And so it just becomes sort of a race of weakness. So for now, since the U.S. Central Bank is sort of leading the charge in terms of versus the European, the euro should stay a little bit stronger than the dollar. Okay. All right. So next up is, and again, thank you for the questions. Cash Insomnia asks, oh, thanks for sharing. Cash Insomnia, I had mentors that were generous with their time with me. And this is just a great way. And I enjoy this, right? Self-servingly, I enjoy doing this. It warms me up for the morning. I enjoy talking to traders who are passionate about trading, who are showing up early, who are prepared. You're my kind of people, right? Folks who just kind of show up at 9:30 and kind of warm up to the market. Well, no, I love the fact that y'all are here 30 minutes before the bell, getting ready, that you're trying to learn something new about the market. That feeds me. So I really do appreciate that. All right, gang. That's pretty much a wrap. So thank you as always for being here. We'll be back tomorrow, same time, same station. We have University of Michigan inflation expectations tomorrow. So we still have some hot zones to come, but it continues to be, generally speaking, by the dip. Nothing's changing, gang. Nothing's changing. Be good to each other, gang. I'll talk with you soon.